busy schedule and maybe your social schedule as well. And also thank you very much for those people who are joining us via our live stream tonight. So thank you for taking time, and we're looking forward to having a good session tonight. We've got a panel of speakers. I myself will be speaking on the London property market and showcasing some of the Barratt's London developments. We have Scott, who is from Capricorn Finance, and he's going to give an update on the UK mortgage market. And we have Colin from Life Residential, and he's going to be giving an update on the property management side. Life Residential share an office with us here in Singapore, but they have about 9 or 10 offices across London, and they're opening offices in other parts of the UK, such as Birmingham, to be able to service clients who want their property managed from there. So basically, I'd like to introduce Scott Mitchell from Capricorn Finance, and he's going to be giving you an update on the UK mortgage market. So thank you. Yep. There we go.
Just clip this on. There we go. Thank you, Richard. Thank you, everybody, for being here tonight. I won't take up too much of your time at the start. As Richard mentioned, I'm going to spend about the first 10 minutes talking about mortgages and finance and how they work with regards to purchasing property in London or throughout the UK. The way that we've got the evening set up is, if you have questions, more than happy to take them, but let's save them until the end of the 3 speakers. Not that we don't want to answer your questions straight away, but we're also going to take questions from posts and people online as well, so we'll consolidate them all at the end and try and answer them as a group for you. All right. So just to give you some background, myself, as Richard said, my name is Scott Mitchell. I work for Capricorn. So I've been doing mortgages and financial services for 25 years. 18 of those years have been based here in Singapore. So I specialise in looking after non-residents, regardless of nationality, non-residents who want to finance a property purchase or refinance an existing property in the UK. For Capricorn, we've been going for 15 years. We're London's largest independent mortgage broker. So what that basically means for you is we've got buying power with the banks and the lenders who can give you a mortgage or give you finance, because we are the single biggest introducer of mortgages to many of the mainstream banks that you may have heard of in the UK. We have our permanent office here in Singapore. That's where I'm based and have been for 18 years. And we also have an office in Hong Kong, as well as the normal sort of residential mortgages that we do for our clients at headquarters in London. We also have our specialist teams, international, which is me, commercial. So if you're going to expand your portfolio and you're going to take on a UK property that may be a business in some shape or form, we can help you finance that as well. Or if you have a portfolio of properties and your borrowing is going to be in excess of £1 million, we can also then lean on our colleagues in the private client department as well, and they can speak to private banks and alternative lenders who can help you source that finance too. Again, for your perspective, we're a whole of market mortgage broker, which basically means we have no restrictions with regards to where we can find you the finance. But as an oversight rule and something that we concentrate on, we do, when sourcing finance for our clients, concentrate on countries where there is a regulatory body that can protect you and protect your money. So, for example, Singapore, we've got the MAS. In the UK, we've got the FCA, the Financial Conduct Authority. But that may well be a Channel Islands version of that, or it could be the Isle of Man, or it could be Malaysia, Hong Kong. As long as there's a government body that makes sure everything is legitimate, we can help you get finance from that source if it suits you. And very finally, hard thing to achieve, so we do like to shout about it, but of the 934 reviews we've got on Google so far, an average of a 5-star. So that's pretty good. And we've got about 5,000 clients in total that we are servicing for mortgages and finance at the moment. To give you an idea, I know this will be hard to see on the screens, on your laptops or your phones or wherever you're joining us online, but what we're just trying to give the impression of here is just the amount of lenders that we can access for you and the kind of banks that we can concentrate on. For clients based in Singapore and non-residents, that tends to be in the private client space, and then down here in the international space. But what can be a little quirky because some of the names you would recognise, for example, Maybank, HSBC, OCBC, Barclays are there as well. Although it could be Maybank, it might not necessarily be the Singapore branch. It could be the KL branch because they are offering something different that suits you. The other week, I did a mortgage for a Singaporean based in Singapore with DBS, but it was DBS London because they could offer him better terms than DBS in Singapore could. So that's the kind of thing that we can do, and that's the way we open it up. A quick market summary for you. What's going on in the UK market right now? Well, the way it tends to work in the UK is mortgage rates are set in comparison to the Bank of England base rates. I know in Singapore we have SIBOR, and in London there used to be LIBOR, but that's pretty much gone now. So the Bank of England sets their base rates, and all the other lenders work out their profit margins over and above that, as a simplistic example of how that works. So right now, the Bank of England base rate is 0.75%. It has gone up recently, twice in fact, since the beginning of the year. However, that was coming off of a historical low. It had never been cheaper in history to get finance. And so in relative terms, in comparison to the last 300 years, sure it's going up, but it's going up from the lowest point it has ever been. So in essence, still a good time to source finance out of the UK if that's what you need to do. Current lenders in the market, there's about 30 plus, 31, 32 lenders who are active in the space of servicing non-residents like yourself, and like me, who want to finance a property in the UK. Each of those lenders, to give you the context, will have about 3 or 4 mortgages to choose from. So that means for you, if there's 30 lenders, 3 or 4 mortgages, your choice is 90 to 120 different mortgages that you could possibly access. So it's a good market. And because of that, there are new lenders entering the market, and there's even existing lenders who are revamping their products all the time because it's a competitive space. So they want to be good and competitive to help you. I'll come on to how some of that looks shortly. The way that Capricorn works with our buying power, I'm not going to pretend that all the lenders give us 0.5% off or 1% off. I think those days in the financial markets are pretty much gone. But what we do get as Capricorn, going back to what I said before about being one of the largest introducers of business to many of these banks, for you, it means when your application form goes in via us, we do get priority service. We do get to the top of the pile, the processing is quicker, we get access to the decision makers immediately instead of through some intermediaries or from other people within the business. We have dedicated managers who look after Capricorn clients. So for you, much faster, much cleaner, much smoother. And then, on top of that, there will be discounts on fees, whether that be arrangement fees or valuation fees or the setup fees that a lender would normally charge if you approach them direct. They will be discounted if you come through us. So how do banks work? What do they do? What do they look for? There's a number of things here. So if you imagine let's say we've got 30 banks. The first thing they do, it's quick and it's dirty, but the way that they identify the clients that they want to work with, is they will ask you what your income is. Where does your money come from right now? Whether that be salary, self-employed, rental income, dividends, it doesn't matter. They just want to know where it comes from. And as a general rule, if your earnings are in excess of £100,000 per year, every single bank will want to work for you. If it's less than 100, but more than 50, you're still choosing from about 90% of those lenders. If it's less than 50, or you don't want to tell them what your income is, or you don't have an income, maybe you live off of other assets, then that leaves you with about 15 to 20% of the banks to choose from. There is no hard and fast rule within that block of 30 to say if you're choosing from 15% of the lenders that your rate is going to be higher or lower. It doesn't work like that. It's just that your pool of choice is slightly lower. But there's always someone out there who can give you the finance, and 99% of the time it just comes down to whether or not the terms and conditions of the loan are something that you want to take on board. But we can usually find an answer for most clients. Another thing about lenders who concentrate on the UK, loan to value. Putting it very simply, maximum you can borrow in the current market is 80%, 80. So you put down 20, the bank gives you 80. However, there are only one, maybe two lenders who can do that. And because there is only one or two lenders who can do that, their rates are much higher than everybody else's. But if you get that to 75% or less, all the way down to 60%, the rates are cheaper. And that's the way UK lenders work. So the bigger the deposit, all the way down to, so you've got 75-25, 70-30, 65-35, 60-40. At 60-40, you're choosing from the cheapest mortgages in the market. You can still borrow less if you wish, but the rates don't get any cheaper. Okay? And that's how the UK lenders decide. Regardless of how long the term is, where the property is, how fast you want to pay it back, the deposit versus the loan to value is what decides how much the lender is going to charge. If you have an existing mortgage, which again is quite unique for the UK, or you have an existing property with no mortgage, one option you also have, and this could happen for you further down the line if this is your first purchase, if you have equity in the property, you can refinance at up to 75-80% if you wish, and if there is excess cash available, you can take that out, and then you can use that to buy another property, or use it for some other means depending on the lender. So for example, if you bought a property 10 years ago for £500,000 and you had a £400,000 mortgage, and then now that property is worth £1 million, even if you haven't paid any of the mortgage off, you've got £600,000 equity, and you could release some of that extra capital to buy more property if that's what you want to do. UK banks will let you do that. I know not all banks in all countries will, but UK banks will let you do that. If you don't want to go on the mortgage, or perhaps you want to work with someone else, or perhaps you want to put your child on the mortgage for some reason, or another family member, guarantor or third-party mortgages are available. A little bit more complicated, and again, we're reducing the pool of lenders, but can be done. Rental income stress tests. This one, it's a bit of a backwards calculation, and it's a little bit different than a residential mortgage, so this is why we talk about it. But there's three basic rules. There are some lenders who require that when we're projecting the rental income of the property, it must be at least 100% of what the mortgage payment will be. Hope that makes sense, right? So if the projected rental income is £1,000 per month, then the maximum you can borrow within the mortgage must be an equivalent mortgage payment of £1,000 a month. But for some lenders, that's 115%, 125%, up to one lender, 145%. Okay? But what the bank is basically saying, at the very worst, this property must break even for you on your cash flow, which I think actually is a pretty good guide for any kind of investment anyway. So it's costing you nothing. They're saying the tenant is going to pay for that mortgage, and then everything else can carry on, and you'll still get the capital growth, and you'll still get everything else that goes along with it. The bank's like that. Terms, rates, and fees. So what are the banks offering at the moment? Buy-to-let interest rates. For the vast majority of my clients in the last few months, the rates they have been choosing for non-residents have been between 3.5 to 4%. 3.75 being the sort of the average within that, obviously. There's a very popular 5-year fixed rate right now at exactly 3.74%, and a lot of my clients have been choosing that one. They want to secure their mortgage, get it at one of the, it's not the cheapest, but it's not the most expensive, but it is one of the longest. So they can lock in the rate at 5%, 3.74% for 5 years. During this period of rising rates, your mortgage will never change. 3.74% will remain for 5 years. Okay. Residential mortgages are available too. So, and this has to be legitimate, if you have the right to remain in the UK, or you have a family member who's going to be using the property either to study or to work or to retire to in the UK, then you don't have to buy an investment mortgage. You can get a residential mortgage just the same as someone who lives in the UK. And then we're talking about interest rates of around 2%. Lenders do ask a few more questions, especially when those applications come from offshore, but they are available for you if that's what you want to do. Lenders' arrangement fees range from 1% to about 1.5%. Again, we can usually get you a discount on that, but that would be 1 to 1.5% of the amount of money that you're borrowing. So £100,000, £1,000 to £1,500. The maximum loan tenure, this is one of my favourites. So the absolute maximum you can go to is 35 years or age 85, whichever comes first. Okay, so if you're 40, I can get you a 35-year mortgage, but if you're 60, I can only get it to 25. And most people ask about that because they want to see how the payments fit, especially when it comes to meeting the income ratio that I mentioned earlier, 100% or 125% or 145%. And that's when the last piece comes in. If this is going to be an investment mortgage, the bank will give you two choices on how you repay. Okay? So we go back to the deposit, your loan to value has decided the interest rate. That's not going to change. But because this is an investment, the lender will say to you, you can choose to pay this back principal and interest or interest only. So the principal piece remains the same and you only service the interest on a monthly basis. Mortgage is exactly the same. Let me reiterate that. Fees, charges, rate, all of that stays the same. This is just how you repay the lender. So why would you do that? Well, let's, for example, say that on a repayment basis, a principal and interest basis, your mortgage is going to be £1,500 per month. Maybe that is outside of the income stress test for that lender. But you could have the exact same mortgage on an interest-only basis, which will reduce your contractual monthly payment to, say, £1,000, and suddenly you're inside the lender's income stress test. And they can say yes. All right? The lender's invented this. It's not something that's been created by mortgage brokers. It's because it's an investment and because you're going to have a tenant, someone else is available to finance this. But the question I do get asked, and I'll preempt it just in case it's going to be asked by you or anybody online, if I never pay the principal, how do I reduce the loan? I saw it in your eyes. So most lenders will allow a percentage per year where you can overpay to reduce the principal if you wish. So going back to that mortgage I mentioned before, 3.74% for 5 years, that lender, for example, allows a 10% per year overpayment without penalty. So in theory, 10% a year over those 5 years of the fixed rate, if you wanted to, you could pay half your mortgage off. Right? Because you've got 10%, 10%, 10%, 10% every year. That's 50% over 5 years. And even if you'd taken a normal or everyday regular principal and interest mortgage, most people don't pay half their mortgage off in 5 years. So it's actually quite a generous allowance. So that's how you manage it. In other words, to simplify that again, every month you pay the interest on the mortgage, and when you reduce the principal, it is up to you. When it suits your cash flow, that's when you do it. And that's how that works. And this is it, almost the last slide. How does it work? The way that we operate at Capricorn is that we would do an assessment with you. We have a simple Word document that we'd ask you to complete. Facts, figures, estimated property if you haven't already got one, or details of your existing properties if you have them. We can do a quick assessment on that. We can give you some quotes based on the numbers and the information that you have given us. That will be based on the lenders in the market today. You would then choose the lender that you like the look of. We would then approach that lender with the information that you've provided and get an approval in principle. So that usually takes 24 to 48 hours. With some of the lenders, that's almost instant because we have back-end access to their assessment system and we can punch in your details directly. It doesn't credit check, it's not recorded or kept anywhere. It's just there to double check that the information you've provided meets the lender's criteria. If it does, and if you need it, we can provide a certificate which allows you to then negotiate for the property, saying, I have been pre-approved for the finance. And if it's going to be a resale property or a property that maybe one or two different buyers are interested in, I'm not going to put words in the mouth of Richard, but potentially, if you've been pre-approved for finance, you may be one step above the person that you're negotiating against. Once we've got that approval in principle back, and you've decided, yes, I've negotiated the price, I've got my property, we do the formal mortgage application. So that would be a little bit more paperwork, passports, payslips, bank statements, mortgage statements if you have an existing mortgage, maybe some credit card statements. We put them together, we package it as the lender has requested, and we ship it off to the lender, or we electronically submit it to the lender. And this is one of the beautiful things about the UK system. As part of that process, the bank will send out an independent valuer to have a look at the property. So they would work for the Royal Institute of Chartered Surveyors. They go and have a look at the property. They make sure the doors work and the hot water runs and everything that's supposed to be there is there. But the other two things they double check, and maybe the most important things, they will double check the property value is correct. and they will also double check that your rental estimates are correct. And that can come back higher, very rarely comes back lower. And assuming that's all correct, the bank then moves to the offer stage. When the bank provides the mortgage offer, that offer is then valid for a maximum of 6 months. So we just take a moment there as well. If you're going to buy off plan, then the soonest we can be involved in the official mortgage process is 6 months before TOP, as we'd call it in Singapore, or 6 months before completion, as they call it in the UK. Because when the surveyor goes out, there has to be a building there for them to see. Right? There has to be something for them to inspect on your behalf. So 6 to 8 weeks through the process, the valuer has been out in the meantime, your offer is issued, and then you've got 6 months to access the money. If the building should still take longer than 6 months, we can usually get an extension, maybe one extension, and then after that, we'd have to reapply for the mortgage. So the last thing we want to do is put you in the process too soon, and then your mortgage offer expires and you've paid all these charges, and then you're not going to get that back because the process happened. So we make sure we get the timing right, so there's enough breathing space that the finance will be ready and waiting before you get the keys. But it won't expire before you get the keys. Hope that makes sense. And then once that mortgage offer has been issued, if everything's going well, it's usually another 2 to 3 weeks on top of that. So maybe 3 months in the best sort of system in the world, 6 to 8 weeks mortgage, 2 to 3 weeks after that, just to finish off the legal paperwork, and everything's done. Usually I say any questions, but we're going to save that to the end. So that's the end of my piece. I appreciate your concentration and your serious eyes. That was very, very useful. My information's there. If somebody's asking a question. So I'm going to welcome up Colin Walpole from Life Residential. And Colin's going to talk about the rental market. Thank you, Colin.
Thank you very much. Which one, this one? And which one's the light? The red one. Where's the little red light? No, there's no need, okay. Good. Thank you. Good evening, everybody. Thank you very much for coming in person, and to everybody that's joining online this evening. As Scott said, my name is Colin Walpole, and I'm the Asia Director for Life Residential here in Singapore. And this evening, I'm going to be giving you a brief introduction as to who we are at Life Residential, the services that we offer, and at the end, I'm going to give you a London rental market overview pre-COVID and post-COVID. And then, as Scott said, we'll take questions at the end of the full presentation. As I said, my name is Colin Walpole. I'm native of Ireland. I've been in the property industry for approximately 17 years, and I've worked in the Irish, Canadian and London real estate markets. And I'm supported here in Singapore by my colleague Anna Ahmed, who is our Client Services Manager here in Singapore.
Colin, can we just ask you to move that way a little bit?
Sorry, cheers. Sorry about that. Thank you. These are some facts of life, and these are our core USPs. Now, I won't take you through each and every one of the USPs, but some of the ones I'd like to point out to you are that we specialise in the new build property market. We've been in business for approximately 20 years, and we manage a portfolio of approximately 4,500 new build units across the London and Birmingham markets. Over that portfolio of 4,500 properties, you can imagine that our rent roll per month is extremely high, and we've managed pre-COVID to maintain that rent arrear level at approximately 0.13% of our total rent roll per month. Now, obviously, that did increase during COVID for obvious reasons, because tenants did struggle with the payment of rent on some occasions, and that maybe they were put on furlough or lost their jobs. But I have to say, overall, landlords were very understanding when it came to negotiating rents during COVID. But the reason we've been able to maintain that rate of 0.13% versus the industry average of approximately 7% is due to a very robust referencing process that we put our applicants through, and that's helped us maintain that percentage. But at the end of the day, we would always advise, no matter how strict we are, people's lives can change after you move in, and we would always recommend that you take out a rental legal protection cover to make sure that you've got 100% peace of mind for protecting your rental payment. The next one I'd like to discuss as another USP is that we have our own completion and handover teams in our head office in Park Royal in West London, and their core job, especially for a new build like we're discussing this evening, is to be the point of contact between you and the developer as we come closer to completion in terms of any key handover, document handover on the day of completion. We will assist you with any snagging requirements. So basically that's whereby the developer will come and invite you to inspect the apartment before completion to identify any snags or defects that need to be rectified. We do a photographing, a written report, we send it to the developer, they rectify, and we go back in to double check that they've been completed. And they'll also give you advice on furnishing, and as I said, we will meet the developer on the day of completion and we'll collect the keys on your behalf. So basically, in terms of people, especially based here in Singapore, who buy a new build, it hopefully makes it less stressful, and we're the point of contact between you and the developer. So there are three of our SOPs. This is our branch network. We have we like to say all of London covered. Our head office is in West London, and we've 10 branches right across London, covering zones 1, 2, 3, 4 and 5. And we've just opened our latest branch in Birmingham, and that opened approximately 3 months ago. We have 2 international offices. As I said, I'm based here in Singapore. I've got responsibility for the likes of Malaysia, Indonesia, Vietnam, Cambodia, and my colleague Patrick covers Hong Kong, Shanghai, mainland China and Australia. And it's just to provide an extra layer of service to our clients here in Singapore, because obviously the time difference of 7 or 8 hours, we're able to have immediate communication, and it's just an extra layer of service that we like to provide. As I've mentioned, some of our other services are our pre-completion services. I've already discussed that with you in terms of completion, snagging, key handover and furnishing. We have a full lettings department. So our lettings department obviously are responsible for the marketing of your unit, viewings, feedback on viewings, negotiating offers between you and the potential tenant, and obviously we will meet the tenant on the day of move-in. We'll meet them at the apartment, hand over the keys with all the necessary paperwork, and we'll take them through the workings of the apartment to make sure that they're settled and happy. Then after the tenant moves in, we've got 3 sets of management services available to you. Each of our clients is assigned a property manager, and they're your point of contact between you and the tenant. So they'll deal with all tenant-related inquiries from the apartment. As you can imagine, and what we're experiencing in London is that legislation on compliance in the London rental market, or the rental market throughout the UK, is becoming very strict. So we have to keep up to date on all legislation changes in the UK property market. And 2 that have come to fruition lately are EICR reports, which is an electrical inspection compliance report, where you have to make sure that all the electrics in the apartment are compliant. And another one is landlord licensing, where a lot of the boroughs throughout the UK are now bringing in licensing, where all landlords have to be licensed with the local borough. They're just 2 examples of legislation that we have to be aware of. Asset management. So we have an asset management team. We will conduct periodic inspections of your apartment and report back to you on the condition, and we will advise on the condition of the apartment and how we believe you may need to spend money to maintain the upkeep of the apartment, and in turn maintain capital and rental appreciation. It's like everything else, as an apartment gets older, it will suffer wear and tear. Items will begin to break or suffer excessive wear and tear and need to be replaced. But we hope to be proactive, and we will supply you reports and recommendations where we can identify the issues earlier and hopefully save a larger outlay of income in the long term. And then finally, accounts. They deal with all financial related matters in relation to your property, service charges, ground rent, maintenance funds, and they do deal with rent and legal or rent arrears. Hopefully it never happens in any of your investments, but they do deal with rent arrears from the day they commence right up until the day that we've been able to evict the tenant from the property. We also have a sales arm, so they offer an in-depth valuation of your property, and we also have a dedicated progression sales team to ensure that the sale doesn't fall through after it's being agreed between buyer and seller. These are just some of our recognitions. We have a 5-star rating overall on Google, a 4.5-star rating on Trustpilot, and in 2021 we were awarded the Best Medium-Sized Lettings Agent in the UK award. That was in conjunction with the Rightmove property portal and the Best Agent Estate Guide. So that we achieved that lately in 2021. So now I'm going to discuss the London rental market overview, to discuss with you briefly what it was like pre-COVID and what it's like now post-COVID, and what we know and what we've learned. So in 2020, approximately February, March 2020, the first 2 months of that year, we were very bullish about where the London property rental market was going to go that year in terms of growth. But unfortunately then come March of 2020, COVID hit, and over the next 1.5 to 2 years, supply levels increased greatly throughout London as people left the city to return to their home countries. Students were not coming back to London, and unfortunately people were put on furlough, lost their jobs for a period of time and had to leave the apartments. So supply levels increased dramatically right across the city. Supply increased, demand had greatly decreased, and rents had decreased anywhere between 10% and 30%, depending on what part of London your property was located. Come Q3 of 2021, when all restrictions had started to ease in London, people started to return from their home cities. Obviously, students started to return as well. We've seen an immediate increase in demand for rental stock in London. So supply from approximately August of last year, supply started to decrease. There was unprecedented demand for rental stock in London, to one point where we had to almost advise people to move into hotels because there was literally no stock to rent in our branches across the city. And now rents started to increase, and now we're back to pre-COVID levels in terms of rent, if not somewhat higher in some areas. And this graph here, for just an example of September 2021 versus 2020 and 2019, that's the total move-ins we conducted in that month. And in fact, in the year of 2021, we had a record year of move-ins into apartments over a 20-year period. So last year was our busiest year. Average rent. Now this is an average rent. No, don't be worried about the figures that we're showing, because this is an average rent across 4,500 properties, across all price levels, across all boroughs in London. But it's just an example as to what happened rents during COVID. So in February, March of 2020, the average rent across the whole portfolio was £1,760. You can see the dramatic effect that COVID had on rents, all the way to July of 2021, where the average rent dropped to £1,587 per month. But now, as I said, rent levels are dramatically increasing, and we're back up to pre-COVID levels, if not higher, in some parts of London. So you'll have to forgive me on the next slide. There's been an error in the slides too. I do apologise. This is in relation to vacant property. On average, across the portfolio before COVID, our average vacancy rate across the whole portfolio ran at about 30 properties that were vacant at any one time. During COVID, that vacancy rate increased to approximately 250 units that were vacant at any one time due to low demand. But now, as of today, I was calling around the branches in London, and we're back down to approximately 15 vacant properties across the whole of London. So demand is still very, very strong in London right now. So this is our market outlook for the next 6 months, subject to no further restrictions from COVID, fingers crossed. So our opinion is that there's going to be continued restriction of supply of quality stock right across all London zones. And we're not expecting these stock levels to increase in the medium term. So right now, right across all of our branches, from the calls I've made today, they're still experiencing a very short supply of quality stock in London. And demand is still very high. So basically what I'm saying, we're in need of quality stock for quality tenants right across London. There's been, obviously, as I said, there's been a continued return of employees and students to London. And I know this is only April, but the guys and the teams in London are already starting to see demand from students who want to be ahead of the game compared to last year, which is very early, but we are actually starting to see student inquiries already, which is going to be a strong indication as to where the market is going to be come now, between now and October, maybe November. Because of COVID and the demand for lets, we've been able to negotiate longer tenancies. So right now, there's no such thing as a 6-month let. We just won't even consider that any longer. The minimum, absolute minimum you should be expecting is 1 year, and now we're starting to push to a 2-year tenancy in certain parts of London because of demand. Tenants also want longer rents because of the instability that was caused by COVID. They're actually looking to secure longer tenancies as well. Tenants and landlords are now seeking to work with reputable letting and management agents as the industry evolves due to compliance and regulation. Demand for quality built apartment with outdoor space, balconies, etc. So Richard will go into this in a little bit more detail as well. But before COVID, proximity to transport links would have been right up there in terms of a tenant's wants and need to be very close to a tube station or rail station, DLR, or whatever the case may be. And outdoor space like balconies, communal parks was high, but nowhere near as high as the demand for proximity to transport. But because of COVID and the people's need for outdoor space, people now want balconies, they want communal areas, they want to be close to parks. So that's taken over from as number one position, while the proximity to rail networks, tube stations has dropped down to maybe second or third. So that's basically what's been caused by COVID, is change in lifestyle, and their wants and needs have changed. So that's it. As Scott said, we'll be here to answer any questions at the end of the presentation, and I'd like to thank you all very much. Thank you. Thanks.
Thank you. Cheers. Cheers. Okay. Is that way around? It's that way, isn't it? Yeah, that's right. There we go. Okay, great. All right, well, thank you very much, ladies and gentlemen. My name's Richard from One Global. I'm from England, and my other speakers here are actually English speaking, one from Scotland and the other from Ireland. So I hope you've been able to understand. If not, with the questions later, I'd be glad to interpret for these guys. So at least you've experienced a mixture of different accents from Ireland and different parts of the UK as well. But again, I'm delighted to have the guests here live tonight, and of course those people coming in online via our stream. I'm going to be giving an overview, initially just an introduction to One Global, especially for those people. We've got a few new faces here. I know we've got some very familiar faces as well. And I will also then be going through a little bit of an update of what's been happening in the UK property market initially, but then doing a bit more of a deep dive into the London property market, which is experiencing a real significant rebound and one of the most exciting times of the London property market, probably for 5 or 6 years. And then at the end of that, we'll be opening up the floor to questions for all three speakers. So that's the roadmap for the rest. So for the benefit of those people who are here for the first time, just a brief to One Global. Singapore is our headquarters, but we've got multiple offices in different parts of the world, and I'll show a map in a moment of where those are. We have very strong capabilities and access to property market in the UK and Australia, but also to a lesser extent in certain other countries in Europe as well. We're members of the leading real estate companies of the world, which gives us access to properties actually all over the world and can co-broke with different agencies around the world. To date, we've got about 50 staff, but every day that seems to be growing. We've grown phenomenally actually through this COVID period. But I think for those people who've not invested overseas before, one of the things that I can appreciate is that if you've never invested outside of Singapore, there's often a concern about the fear of the unknown. How do I know this is a good country, first of all, to invest in? What about the city? If I do invest, who's going to help me find a mortgage? Well, we've got the likes of Scott. Who's going to help with managing the property? Well, we've got the likes of Colin. And one of the great benefits of having support vendors such as Capricorn Finance and Life Residential here in Singapore is that you can actually meet them face to face and work in the same time zone as well. So once somebody has decided to invest, we have the mortgage brokers to help access the property financing as we get closer to the property. If it's an off-plan property to being delivered and completed, Life Residential can come in and assist with the handover and the long-term property management side. And as Colin has mentioned, they'll do everything from the handover and the snagging, marketing the property, finding the tenant, managing it on a day-to-day basis, collecting the rent, all the way through to reselling it at some stage in the future so that you can take back your profit. So we call this a complete end-to-end service, and we hope that as we have an opportunity to build your trust and our credibility, that you can have peace of mind that your hard-earned cash and your property and assets are going to be well looked after, all the way from the initial consultation through to selling the property and taking back your profits. We do have other teams as well. I specialise particularly in the international project marketing team for overseas property, but we also have a local team for those people who are interested in buying and selling their own local property. We also have a private office, and the private office specialises very much in people who are looking for a bespoke search, typically of properties of £1 million and upwards. It might be for a family office or an institutional investor. They might be looking at buying a building, a portfolio of properties, or it might be somebody who's wishing to get involved with being a joint partner in a development scheme. And we can bring the parties together and coordinate that. So there's a variety of different services we have, but tonight we're sort of focusing on the international project marketing, and tonight we'll be going through, as I say, more about the UK and London property market. But this just shows where the offices are around the globe. So as I've mentioned, Singapore is the headquarters. We have also offices in Kuala Lumpur, Hong Kong, Middle East in Dubai, Cape Town, and in the UK. So we have grown from being just one country in Singapore to a multinational company now. So let's get into the main part of the presentation, and I'm going to go through a few slides to really look at some key macro things that are impacting the UK property market. I arrived in Singapore in July of 1997, so I'm into my 27th year, and hopefully what that can do for people who are here tonight and those online is I can give some perspective of having lived in Singapore, have bought and sold property in Singapore, but I was born and raised in Oxford, England, and very familiar with the UK property market, and hopefully can give the best of both worlds. Now, when I arrived in Singapore in July 95, the exchange rate between the Sing dollar and pound sterling was about 2.6 Sing dollars to the pound sterling. If we took this graph back a few more years to about 2007, I remember selling a property in the UK and the exchange rate was actually 3.15 Singapore dollars to the pound. So I did very well in terms of the exchange rate, and I actually did very well from the sale of the property as well. But what we can see in the last 10 years is that the Singapore dollar relative to the pound sterling has got stronger and stronger. There have been certain milestones where there's been a significant change. So here was when we had the Brexit referendum, it was roughly 2.2 Singapore dollar to the pound, and within a few months had dropped by about 20% to about 1.8. And for the last 5 years or so, since that Brexit referendum, it's literally hovered round about the 1.8 Sing dollars to the pound. In fact, last week, I hadn't looked at it this week, but last week it was about 1.77. So the point I'm making here is that over the 27 years, at least I've lived in Singapore, the buying power of the Sing dollar, even when I look at from just 5 years ago, is about 20% stronger. And if I went back to 2007, it's about 30% stronger, which is almost like getting a 30% discount using the buying power of the Sing dollar, which I assume most people are using being based in Singapore when buying a UK asset like a property. So from a timing point of view, there's been no better time from an FX perspective in the last 27 years. Now, when it comes to key fundamentals of a market, supply-demand has a major impact. And the two key things is how much property is being built and delivered into the market, and what is the population growth or decline in that country or that city or that neighborhood. So those are the two things that have the major impact on supply-demand. This slide is actually going back to 1988, so we're going back over 30 years and demonstrating how many properties were being delivered each year into the UK property market. And if you can read the bullet point at the bottom, and for our viewers streaming in who probably can't, it says the government estimates and puts the need for additional housing in England at between 232,000 to 300,000 units per year in order to overcome the shortfall, which at the moment is between 40 to 53% every year. So basically, if we're looking at somewhere in the middle, 250,000, we can see that in the last 30 years, not 1 year has the UK been able to deliver enough properties. And people will say, well, why don't you just build more? Why doesn't the government do things to build more? Well, they're certainly trying, but it's not like you can just flip a switch and suddenly all the developers have got the access to the financing, they can find the land, they can get it through planning permission, build it and have ready property. It takes sometimes between 3 to 5 years to deliver a property from finding the land, getting the planning permission, building it, and eventually having people living in it. So the fundamentals of the UK is that it's chronically short of property, which is great if you're an investor because it continues to drive up prices. Not so good if you're a first-time buyer trying to get on the market and prices keep going up. Now, this is slightly old, but the data is not that dissimilar. So going back to the middle of last year, the average price of property in June from the previous year, the average increase was 13.2%, which is quite a phenomenal capital growth across the UK on average. The graph here shows over the last, going back to 2006, the average price of a property in the UK. We can see going back to just about 2005, it's around about £150,000. Today it's at £265,000. In fact, it's gone slightly higher than that. You'll notice here a bit of a wobble, and that's the biggest wobble or the biggest decline in UK house prices since records began about 60 years ago. Anyone can guess what caused that decline in property prices? Just to see if you're still awake. It's Friday evening, you might have had a glass of wine. Yes, the global financial crisis. So the global financial crisis hit. It was certainly, at least in the US, triggered by a real estate bubble, but it had a major impact on real estate around the world. And so prices of property in the UK came down about 18-19%. That's the biggest drop since records began. Compared with other markets like Singapore, Hong Kong, actually that was a relatively small drop. But we can see within a year it starts to recover. And interestingly enough, when we look at the last year, the graph is getting steeper, which effectively means the prices are accelerating faster in this last year than almost any other time in the last 2 decades, which might seem a bit counterintuitive when we consider we've just gone through one of the biggest turmoils, certainly I think in our lifetimes, But I'll explain a little bit more about why that has occurred in just a moment. Breaking down the UK into different regions, looking at then the average increase in prices in these different regions, we can see in the northwest of England, so Liverpool, Manchester region, that the average price of properties in those areas have gone up by about 18%. So if you've got properties in that area, you'll have done extremely well. Actually, the whole of the UK has done phenomenally well, but some better than others. When we look at somewhere like the West Midlands, that's where Birmingham is, so one of the other big major cities in the UK. Again, that's seen an average of about 15% increase. It's interesting that London, when I first came to Singapore, and if I look back 10, 15 years, very often if I spoke to an investor, they say, oh, I'm only going to invest in London. And interesting enough, London, although 6% growth is a phenomenal year in any normal year, it's actually the least amount of growth compared with any other region in the UK. But there lies an opportunity, and I'm going to again expand on that, because London, and particularly prime central London, is heavily driven by overseas high net worth investors, people like yourselves. And during the pandemic, many people have not been able to travel there. And if they can't travel and see some of the bigger ticket properties, they're not buying. So the number of transactions were very subdued during the times when travel was restricted. Prior to that, we had Brexit. And there was a lot of negative news coming out all the time. And how many times was I speaking with clients and they say, well, let me just see, I'm not quite sure how the economy is going to go. Our prices are probably going to drop. I'll just ride out the storm, so to speak. I get it. I understand why. But the fundamentals of the UK property market were still very sound. And we were seeing, except in London, property prices continue to rise. So why is it that we think that London is looking very hot at the moment? Well, other regions have done extremely well, and even through the Brexit, they were ticking along very nicely. But London came down in price, and you'll see in a moment some graphs to demonstrate through Brexit and soon after Brexit, prices coming down, staying very low during the early parts of COVID, but now we're starting to see a major rebound. So what is it that's caused this phenomenal growth across the UK in a time that's been unprecedented in our lifetime? It's a variety of factors. If we go back to the beginning of 2020, in fact, the month before, in December 2019, Boris Johnson just basically wins a landslide election. Brexit has been done, and a big cloud has been lifted, and there's a lot of confidence that's coming back to the UK. Property prices started to go up. Then COVID hits. Suddenly, transactions stop. Why? Valuers couldn't go out and do valuations. If they can't do valuations, they can't issue mortgages. And if people can't get mortgages, most people can't do a transaction. At the same time, people weren't sure whether the economy is going to fall off a cliff, prices are going to drop. So very, very subdued market during that time. But then the government in July of 2020 introduces a temporary stamp duty holiday, saving up to £15,000 on a property up to £500,000. And suddenly you've got a catalyst. On top of that, you've got the lowest interest rates in over 300 years, and there's a high correlation between low interest rates and a buoyant market. And then, in addition to that, you've got other factors such as people are now being locked up for 3 or 4 months, and they realise that they might be working from home, so I need maybe an extra room for a home office. Having access to either a balcony, communal gardens within the condo, or a garden, landed property, or access to parkland nearby became a major importance when selecting a property to either rent or to live in. So people's requirement from their property rapidly changed within about 3 months. And all these factors put together, a catalyst of a stamp duty holiday, the lowest interest rate since records began, so people taking advantage, locking into fixed rate mortgages, upgrading their property so they've got more space, an extra room, or somewhere that's got access to parkland or other space. So suddenly there's a massive surge in property activity as we start going through towards the end of 2020, and it accelerating through 2021 through to the stamp duty holiday, which ended in September last year. And many people thought that when that stamp duty holiday incentive finished, the property market would start to take a nosedive, but it hasn't. It's continued to rise both in rentals and in capital growth. So I hope that gives you some context to the UK. Let's now have a look at London and getting a little bit more specific to the capital city. So why London? So some key factors. It's a robust economy. It's a very, very diverse economy. You've got a population of over 8 million people. It's a massive international cosmopolitan city. Many people want a piece of it, and hence people buying and investing into it, as well as actually people having their offices there as well. We've mentioned historically low interest rates, an extremely favourable exchange rate, a massive undersupply of homes, world-class education across the UK, but particularly London. We've got over 500,000 students. That's a lot of rooms or apartments to rent out. Crossrail, a high-speed rail that is about to be delivered at long last, which will revolutionise and be a game changer in terms of the speed of which you can cross from east to west of London, and a whole host of other things as well. So London population, you remember I mentioned earlier that supply-demand is heavily impacted by two things. Population, whether that's increasing or decreasing, and the supply of property coming onto the market. It's always a good sign if a city is growing in population, because what it's doing is attracting more people. They're usually coming in for employment reasons. And if they're coming in to work, they need somewhere to live. And so when you see population increasing from roughly at the moment just under 9 million, going up to, in the next 10 years or so, getting up to about 10 million, an increase of about 10% over the next decade or so. And that's a lot of houses that need to be built. Well, when we look at the supply of property compared with demand, what's happened during this COVID time is that lots of people are interested in upgrading their property. The new build property has slowed down because developers and construction workers haven't always been able to get on site, or it might be a diminished amount of construction workers to get on site. So supply is diminished, but demand is buoyant because of the stamp duty holidays, low interest rates, wanting to rethink where do I now live, and upgrading to a larger property, maybe close to an open space. It's estimated that London needs 52,000 homes every single year in order to keep up with demand. Now, this keeps increasing, this figure. If you went back 20 years, it was at about 30,000. If you went back 10 years, it was at about 43,000. It's now going up to 52,000, which tells us the situation is getting worse rather than better. Again, that's a great thing if you're a landlord and an investor, because it's going to continue to drive up prices. Not so good if you're trying to get on the property market. So it all bodes well if you're an investor. So this actually shows the new housing supply. Now remember, 52,000 units are needed every single year to keep up with demand. Go back to 2010, 2,500 delivered. The maximum over the last 10 years or so was 12,500, and as we've come through into COVID, that's dropped off again, partly because of the reasons I said. Developers and construction workers couldn't get on site, so the delivery of many developments has been delayed, and so new supply has reduced, exasperating the situation still further. Now, these are some new graphs that our research department just brought up, and there's some real relevance to this. These are, I hope you're not colourblind, anybody. These are showing the London Underground passenger figures. So prior to COVID, 2019, the London Underground, or the equivalent of the MRT system, was averaging just over 100 million people using every single month. This is the month, so this would be February, April, June, and so on throughout the year. We go into 2020, beginning of the year was fine. COVID hits. Boom. Suddenly, number of passengers because of lockdown almost goes down to 0. After the first lockdown, things start loosening up. Okay, a little bit of travel, blah, blah, blah. Go into 2021, the UK, certainly as we get into the second half of the year, starts to relax the policies. There was several ins and outs and different regions getting locked down and so on, but we can see the trend is building back up. Interesting enough though, towards the end of last year, suddenly a drop-off. Now what happened was this Omicron started to hit, and again there was concerns, a little bit more restriction in terms of movement around, and so we see a bit of a drop-off. But 2022, we're about to update this next week actually, but we can see that there is definitely an increase in the passenger traffic on the London Underground. Well, why is this important? Well, it shows us that people are on the move. They're not locked up. And what we're starting to see is this rebound that during the early parts of COVID, there was a flight out of the city centre to the outskirts of London, what we call the home counties, the commuter belt towns around London, and even people just moving back to their parents' place, to save on rent because they didn't need to be going into the office. But what we are seeing is that in the last 6 months, there has been a significant boomerang effect, we call it, with people now moving, or rather working back in the office, and people's attraction then to be renting back in the city centre or buying property also into the city. Now, this is the Heathrow passenger. Similar kind of graph. We can see in 2019, over 6 million passengers per month going through Heathrow Airport. 2020, COVID hits, boom, virtually nothing, gets up a little bit. 2021 starts to improve. The early part of 2022 really starting to pick up, and we expect this, as the year progresses, probably to get back close to pre-pandemic levels. So why is this important again? Well, if you remember what I said about London, and particularly central London, is so heavily influenced by overseas investors. And if overseas investors who have been sitting on the fence for 5 or 6 years during Brexit and then couldn't travel during COVID can now get there, suddenly there's this pent-up demand of people who are thinking now, okay, I can get there. Prices have come down anywhere between 8 to 15% during that Brexit referendum period. So prices are low. I haven't been there for a long time. I haven't bought a property. I've been sitting on the fence. So things like, really heating up. This is in August of last year. Average London house prices jumped 28,000 in August of last year, the biggest single increase in property prices in any month in 27 years. If we put this into, daily figures, that's almost the price of the average property in London going up by £1,000 almost per day. Not a bad return and increase. So what we're seeing is people are now being able to travel, go back to London, have a look, buy the property, see it's at a low point, and so the market seems to be really turning rapidly. So let's put this into some more data. So this is prices, prime central London in the red, and in the sort of purpley blue, prime outer London. We go back to 2015. Some context here. After the global financial crisis, we saw that prices came down about 19% on average, but then started to pick up. London property prices from 2009 to about 2014 absolutely shot up. If you got in at the market at about 2010, you'd have been laughing all the way to the bank. I think it would be fair to say that it probably overheated. And at about 2014-15, prices did start to moderate, and probably correct is probably the right answer. Then 2016, the Brexit referendum occurs, and prices come down. There was a little bit of an increase, but then again, negative news about Brexit, prices still coming down, people sitting on the fence. End of 2019, Boris Johnson gets voted in, confidence is resuming, Brexit's lifted, prices start to go up, and then COVID hits and prices drop again. But look what's happened in sort of the middle to end of 2021. Significant increase, particularly on the outer parts of London, this blue line, because what we've experienced really in the last 12 months is that there is a boomerang effect of people coming back to London. There are some people that say, okay, I still need to be in London, but because I'm only traveling to the office now once a week, I'm not having to go there full time. I don't need to be in the city centre. I want to be close to a park. I want to save some money, so if I'm renting, I'm not having to pay as much rent in an outer suburb, but I'd still like some connectivity so that when I do need to go into the office, it's easy to connect in. So we started to see that the outer parts of the London suburbs were actually performing slightly better than the prime centre. But now that people really are, international travel is coming back, people are moving back to the office, people are being encouraged with many companies to go back full time, we're starting to see really prime central London also starting to boom as well. Now, Colm had a similar slide. This is the annual rental growth. And we can see this is just prior to COVID. COVID hits in 2020, rents plummet. But it really is an absolute V-shape. So that by 2021, as things start to improve, people start returning to the office, rents start coming up. And this is for central London, outer London, and prime central houses in London. So a real rebound. And what we're seeing now is that rentals are almost back, if not slightly higher than what they were pre-COVID. Now, actually, this is one of Colm's slides, and I think this was the one he was looking for when he was talking earlier. Vacancy rates. This is a very important statistic because it really gives you an indication of what the supply-demand is in that country, or in this case, in the city. So Colm's company, Life Residential, manage about 4,000 to 4,500 properties across London. This represents the number of units out of those 4,000 plus which are vacant at any one month. So prior to COVID, looking about 39. At the height of COVID during the lockdown and people getting furloughed, losing their jobs, that went to 209. 209 out of 4,000, that's about a 5%. This is your slide, Colm. This is about a 5% vacancy rate. But when we come again through to the end of 2001, we're down to 38. Colm mentioned they're now down to about 15. 38, when I did the calculation, represents about a vacancy rate of 0.75. If they're down to 15, that's probably about 0.3% vacancy rate. That effectively means when a unit comes on the market, you have got people queuing up to want to rent that property. So again, it's a real, landlord's market at the moment, and rents, as we can see, have rebounded extremely strongly. All right, so that's kind of what's happened. Let's look into the crystal ball now and see what is going to happen, or predicted at least, into the future. So I've got a few slides here. This particular one is by Savills, and it's basically showing the next 5 years capital growth projections for prime central London, prime outer London. Look at what we see here. 2022, it's estimated that prime central London, what I mean by that is really zones 1 and 2, the centre there, is predicted to go up by 8% this year and 4% next year. That's an increase of 12%. Over the next 5 years, 23.9%. The outskirts in 2021 actually probably performed a little bit better than the central parts. But even still, this year it's predicted to go up by 4% this year and 3% next year. Again, a very healthy overall increase. So what we're seeing is, again, it's predicted by the analysts that prime central London is going to see a very strong rebound for all the reasons I've mentioned earlier over the next 1 or 2 years. These are the prime rents. Now we've got the weather forecast for 2021. Prime London 2021, the increase was only 1%. But look at prime commuters zone in the outer skirts of London, 5.5. But in 2022, that's predicted to flip itself Prime central London, rents going up by 4.5%, and the outer skirts by 1.5%. So if you think about renters, they're far more transient than people buying property, because you can give notice, leave the property, let's say in a month, if you decide that you want to relocate because you're now working full-time in the office or you're working only part-time. You can be flexible and choosy where you go. So interesting figures in terms of what's happening on the rental market there. So just for comparison, because analysts have different data, but it's interesting that Jones Lang LaSalle, not that different. When we look at prime central London capital growth, we're looking at an increase estimated of 7.5. Savills said 8%. Next year is 5%. Savills said 4%. So put those two figures together. When we look at Greater London, this is taking the whole of London. So again, 6% is the estimate for this year, 5.5% for, on average, Greater London. And then when we look at the actual rentals, prime central London looking at 6% this year and 3.5% the next year, Greater London 4 and 3. Again, very healthy growth figures. Okay, that I believe comes to the end of the presentation on some of the facts and figures. I appreciate it's a little bit dry and there's lots of figures and numbers, but we're very data driven. And what we want to do is help clients like yourself make well-informed, educated decisions based on data, not fluffy pictures and hype and emotion. Now, the next part of the presentation, we're going to be just highlighting two projects in London, both by Barratt's. Now, Barratt's, if you're not familiar with them, are one of the top developers in the UK. They're a large public listed company. They are the biggest developer in terms of the number of units they deliver each year into the UK property market. They have a 5-star customer service rating, which I'll go into in a moment. And again, when you're dealing with a top quality developer, you can have that peace of mind that you're going to have a quality product that's built, which is a major factor, but built to high quality as well. So these are just some of the facts and figures. So when I mentioned about that customer rating, 90% rating, what does that mean? They actually survey, and this is something that's done throughout developers across the UK, that developers are surveyed and they ask the owner-occupiers, what was your level of satisfaction? Would you recommend this developer to somebody else based on your buying experience, and now that you've moved into the property, have your expectations been met or surpassed? And Barratt's have a 90% approval, and this is one of the highest, and they've been receiving this year on year, I think back until about 2010, if I remember rightly. They develop property across the UK, but particularly strong across zones 1 to 5 in London. They're a FTSE 100 company, largest developer by volume of the UK, nearly 18,000 homes built last year, over 60 years of experience. So again, you can see very, very experienced. They have an NHBC building warranty for 10 years and some of the fixtures and so on for an additional 2 years as well. These are just some of their figures as well. Total completions, almost 18,000. Operating margin, almost 17%. Profit before tax, over 900 million. So again, hopefully giving you confidence you're dealing with a very, very solid developer. 1.7% is the average 2-year fixed rate for a mortgage. This is probably for somebody living in the UK, I'd imagine, isn't it? So if you were residing there, then there's less risk, and so banks, if you do reside in the UK, will factor that into the mortgage and give a lower rate. So if you were relocating or moving back, there are opportunities to get very favourable rates as well. They're buying into the land. Government targets, we've mentioned over 300 homes. So again, if you're an investor, the target is 300,000 homes, but the UK is delivering nowhere near that number. And this just is a map of London showing where their present projects are. We're focusing on this one here, Western Circus, which is in Acton. That's just in Zone 2. And Ridgeway Views, which is almost like you'll see living in a rural village, yet you are living in Greater London. So, urban living in Zone 2, the Western Circus in Acton. Is anyone familiar with London, Acton area? I'm reasonably familiar. I'm from Oxford, so when I would drive in to London, I would come through, the likes of Acton, Ealing, Shepherd's Bush, Notting Hill, coming through that way. So it's a great location. Literally a 5-minute walk to East Acton Station. You're then on the Central Line and can get into Oxford Circus in 18 minutes. Crossrail will basically become operational later this year, and at the Acton Main Line, you can then get into Bond Street in just 9 minutes. Lots of shopping malls. You've got Westfield, which is a massive shopping mall very close by. 22% expected capital growth in the next 5 years. Again, that's on CBR. I've shown JLL and Savills a little bit earlier. So this is a map showing, again, a bit more of a zoom in. So just to get your bearings, Chelsea, Westminster, Mayfair, Hyde Park, Kensington. So you can see, this would be Zone 1. So we're into Zone 2, East Acton in this region here. In terms of just some of the facilities, it's got private outdoor space, landscaped communal garden, so it's got some nice open communal garden you can see around, which we know is important these days. It's got a supermarket in there, cafe and shop, great views across London on the higher floors, car club scheme. We've mentioned a 5-minute walk to East Acton and 23 minutes into Oxford Circus. Again, Barratt's are renowned for doing, very good high quality furnishings and finishes. When it comes to some of the key things, most of the Barratt's projects are 999-year leases. For people who are not familiar with the UK, apartments aren't freehold. Then the least leasehold is 125 years. 250 is, let's say, average. 999, it's almost as good as freehold. So, it's nice that it's that length in terms of its freehold. Price is starting from £437,000 for Zone 2. That's very, very good. It comes in, I think, at about £800 per square foot. It was somewhere, it may be on another slide. 10 years NHBC warranty as well. And payment terms, very attractive. You only need to put 10% down now and then 90% on completion. Now, this project is due for completion literally in a few months in the summer of this year. But again, it's nice that you're putting a relatively small deposit. Many developers will ask 15, 20, sometimes up to 25%. So you know that basically you've got 10%, the building's almost completed, so there's virtually no development risk. And if it's an investment, then within maybe 3 or 4 months when it's completed, you've got income coming in and you're starting to get a rental return as well. The other one is Ridgeway Views. And as you can kind of see, what they've done is taken a plot of land next to, behind here is like open fields, and there's a park on this side here, and they've basically built kind of your own community village in a very, very rural, immediate setting, but yet you're in Greater London. So when we look at the profile of either tenant or buyer who's looking for that, what I call this hybrid lifestyle. They would like to be relatively close to London so that if they're going into the office once a week, they can get onto the train or the underground, but they can be further out where the rent is less expensive or the purchase price is less expensive and enjoy the greenery and the space of living in an outer suburb. Or what I would really say, as you'll see some of these photos, a bit like a village look. In fact, I'll go to this slide here just to, these, I couldn't believe it when I first saw, this is the meeting surroundings. It looks like I'm in rural England, beautiful old sort of village houses. They've got a duck pond in Mill Hill Village, which is a few minutes walk away. So really, again, really nice blend if you're the kind of person that wants to be living in that environment, but still close proximity to London. So as I say, new homes are released. Parking is available for all homes. Residence gym, concierge, so nice facilities. Ridgeway Views lifestyle, just 30 minutes from central London. So that kind of gives you an indication of how quickly you can get into central London. It sits on a little hilltop, so again, nice prominent position. It's set in 47 acres, over 4,000 trees, and close to many leisure, golf, and other recreation activities. So you can see here on the map, so we're going into, again, let me see, get my bearings, East Finchley. So central London would be down about here. So we're in sort of north to northeast London. We've got Mill Hill, which is the main train line going into London, and also the underground Mill Hill East Station. Connections are about 90 minutes to St Pancras on the overground, 21 minutes into Euston, 25 minutes into Tottenham Court Road. So again, depends on what you're looking for, but you know, a real nice hybrid style of property if you're looking for the best of both worlds. Access to central London, but living in a village, green, leafy neighbourhood. Okay, we're nearly there. So this shows actually the landscape of the and layout of the development. These are actually houses. So these are landed properties. These are their own private gardens. And then all of these different blocks, as you can see, they all have an outdoor space, balcony, lots of garden, communal space, and a very large clubhouse with the facilities that I just mentioned earlier. So again, 999-year lease, you know, great payment terms, 10%. This one is actually completed. So again, if you wanted something that you get an immediate return on, then this one is already completed. So I think we're just about, yep, we've got to the end there. What I'd like to do, if you haven't run away, is, well, first of all, thank the audience for your attention. I know that's been quite a lot to take in with 3 different speakers, and for those of you online. But I'm going to bring back Colin and Scott from the lending and property management company. So the 3 amigos with different accents can answer questions and hopefully address any concerns or issues that you may have. So let me open up the floor to fire away. And if there are any questions coming in via our live stream, we'll try to answer those tonight. If we can't, we'll definitely answer those via emails or calls in the near future. So can I open up the floor to any questions?
I'll start.
Thank you.
Okay, so I have questions for all 3, just to be fair. And I will go in the order of the presentation. So the first question is for Scott.
Yep.
You did mention this divide between buy-to-let mortgages and then residential mortgages.
Yep.
And I understand that most Singaporeans would be buying-to-let, so they would fall in the first category. What if I was buying to use the apartment in central London for myself, but I'm not going to be there all of the time, so I don't have a visa to stay for too long. I'm going to go in on a a holiday. I don't even need a visa, right, if I'm just going in for a limited amount of time, but I do foresee that I will be going in regularly, like maybe once every 3 months or once every 6 months, and I do want to use the apartment that I bought for my home stay, but I'm just not there all the time, right? I'm like a non-dom. That's the buzzword now since Rishi Sunak.
Controversial word, but nice, thank you. Yeah.
So the thing is, would I be able to qualify for the residential mortgage terms as opposed to the buy-to-let?
Yes.
And what do I have to do to qualify for that? As long as I don't rent it out, is that...
That's basically it. If it's genuinely for personal use or family use, then
right?
yep, residential.
I'm just using it for like 100 days out of 365 days, right?
Fine.
And what if like halfway through I decide to then rent it out because I've gotten sick of flying, from Singapore to London and back?
You have to guarantee you're not going to let it out.
Sorry, what?
Do you have to guarantee you want to let it out to enjoy?
Yeah, so what happens if I change my mind? That's the thing.
Okay.
I can guarantee at one point in time, but if my life situation changes and I do need to let it out, is there a way of converting the mortgage?
Okay, so 2 answers to that, and very good questions, so thank you. The first response would be, in that scenario, when that happens for a client, we will compose a letter. It's a letter. It's like speaking to your MP. You have to write a letter, send it to the bank, explain that your circumstances have changed, and ask them for permission to let. And they'll do a review of your circumstances and perhaps offer you, it could be anywhere between 6 months to 2 years, and they will allow you maybe with a fee on top or maybe with a slight adjustment to the interest rate, but they'll give you permission to let. Worst case scenario is they'll say, thanks for letting us know. If you decide to do this, you're going to have to repay the loan, and then we would find you a new buy-to-let loan. But I've been doing this for 25 years, and I've never had anybody yet be refused permission to let, as long as it's a genuine scenario. If you did it the day after you completed, the bank would ask some questions. But a year, year and a half, 2 years later, usually not an issue.
Thank you. But it does sound like what you're describing, which is you go to the bank for permission, and then they kind of do a waiver, and they let you let for, is that like a limited time, or from henceforth you can let?
For up to 2 years maximum is the longest I've seen. And then it's reviewed. Yeah.
Right, okay. And what happens if, like, after 2 years I still have to let it out? Then what you're describing will kick in, right? Like they will either convert the loan or they will terminate the loan.
It usually ties in with the end of your lock-in period or your redemption penalty period, if that was in the mortgage in the first place. Right? So if you'd chosen a 2-year mortgage with a lock-in, then perhaps they would just get it to the end of that lock-in period, and then you can refinance it onto a buy-to-let mortgage anyway. Right?
Okay.
They're going to banks are, as much as their reputation maybe says no, they're usually pretty reasonable, as long as the circumstances are genuine.
Okay, thank you.
All right.
The second question I have, I mean, I'm talking, maybe I should let the gentleman go first. I shouldn't be asking.
Okay, just want to know for Western Circle, what is the expected rental for a 2-bedroom?
Expected rental for a 2-bed, sorry, me bad. So we've done the projections for both developments actually, and as Richard said in his presentation, the minimum yields in both developments are working out at 4% or above 4%. So it really does depend on, it'll depend on your floor level. So the lower you are down in the development, your rents are lower, and as you go higher up throughout the development. So minimum we're expecting for a 2-bed in Western Circus is 1750, all the 1750 per month, as high as 2050 per month on the higher floors. Your minimum 4% on a 2-bed in minimum 4, yeah. 1 bed in Western Circus we're predicting anywhere between 1550 to 1700 per month. Again, being 1550 being on your lower floor, all the way up to 1700 per month on the higher floors.
And will that go down over the year?
Sorry?
Will the rental go down?
Well, we're predicting based on our current projections and the medium to long-term outlook, you're looking at approximately 3 to 4% growth per year.
These are basically fully furnished apartments?
Yeah, we would always recommend fully furnished, because from our experience, an unfurnished unit will tend to stay longer on the rental market. There's less demand for unfurnished, and unfortunately, if it's unfurnished and there's less demand, in turn it increases your void period, and void periods obviously are expensive. So we always recommend furnished. Doesn't have to be John Lewis, but we would never recommend on the lower end either. It would just need to be comfortable, durable and hard wearing, but definitely furnished we recommend. Oh, wow. If you give me a couple of minutes, I'll do a calculation. I always work off monthly, sorry. So that's, sorry, okay. If it's 1750 multiplied by 12 divided by 52.
Divided by 12?
1750. Yeah, sorry, I always work off monthly. I'm old school, sorry.
How much is the difference between fully furnished and non-furnished?
Well, there's not necessarily a difference. It's the length of time it takes to let. You may look at approximately £50 per month lower for an unfurnished unit, but if the demand is way higher for furnished, unfortunately your unfurnished property traditionally stays longer on the market. And if you have 1 month of a void, purely for argument's sake, that's already cost you £1,750 in rental income. So our advice is always furnish. You may not get an increase in the rental figure because it's furnished, but it will pay for itself over the long term because your void period is absolutely minimised. Yeah. Does that answer your question? Oh, no worries. Thank you. Yeah. Yeah.
I have a situation where my own apartment was fully furnished.
Yeah.
The tenant said, I don't need furniture. So I'm going to remove the furniture. She said, I just need a bed and the rental we take.
Okay.
So, which is good, right?
It is good, yeah, but I would never say...
Depends on the...
It does. It depends on the tenant. It depends on you as an owner. Depends on the location. Now, obviously, with you having to remove the furniture, there's a cost involved in that.
There's no cost
No cost. Removing the furniture.
for me.
And did you sell it or store it?
The what?
In terms of the furniture, did you,
It was a furnishing company, right? So they were just more than happy to take it.
was it like you rented the furniture? Is that correct?
Yeah, it was rental furniture.
Oh, you rented the...
Sorry, it wasn't rental. It wasn't rental. It was just that they're just a nice furnishing company.
Okay.
Maybe because of me.
All right, okay.
So,
Okay, that was...
the first tenant?
the what?
Was it the first tenant?
Was it? I can't remember.
Okay.
No, it wasn't.
If it was going into your first, second, or third tenancy, and a tenant wants furniture removed, personally speaking, I would never ask or expect a landlord to remove the furniture, because number one, you've paid for it. Number two, you're going to have to go to the expense of removing it. You're going to have to go to the expense of storing it. So you never... That was very nice what you did in terms of removing the furniture, but you don't have to go to that extent in terms of renting your apartment because of demand. I would imagine approximately 99% of apartments are rented furnished. So they are. What part of London was the property in? Just what location is your...
The east side.
East side. Okay.
I mean, it's all the same, right? It's just,
Yeah, well, East side is a very popular area of London.
it depends on the furnishing company.
Yeah, exactly, yeah.
What he said,
Yeah,
so they turn around the furniture.
yeah,
So even though they take it away, I mean, they just do it up, clean it, and then they...
exactly. As long as it was never used or there's no wear and tear.
I mean, yeah, I know it.
Okay.
I do have sorry. I do have the point, although I'm actually I'm standing where you are.
Okay.
I do think, I mean, as a landlord, not just, I mean, more in Singapore than anywhere else, that I do believe that if you do furnish your property properly, it does help to move it a lot faster.
Mhm.
It also helps to get better quality tenants because it attracts that kind of tenant who likes
Mhm.
your decor and will look after it. So that's a plus point, right? But
Absolutely.
as a moot point, though, and I think I've come across this before, the more you provide that's included in the tenancy, the more you're responsible for the
Correct.
replacement.
Okay.
So if you're gonna like let it out empty, the chances of you all having to replace anything are much less than if you furnished it with 100 things, and then throughout the course of the tenancy, if something breaks down, then you are then responsible for replacing it because it's included in the tenancy. So I think that's something that people have to be
Correct.
aware of.
Very, very good
If
point.
you cut flowers and then you're expecting me to replace the cut flowers every week, then I would say bugger off. Like,
Okay.
I'm gonna rent to you, right?
Okay, I absolutely agree with what you've said. In terms of furnishing, I always advise a landlord just go with the large ticket items, beds, sofa, mattresses, coffee table, dining room table and chairs. Certain furniture companies will offer you the bells and whistles like bed linen, towels, cutlery, hoovers. But if you supply it as a landlord and it breaks down to wear and tear or negligence, number one, we have to prove that the tenant broke it. If we can't prove that the tenant broke it, unfortunately, you as the landlord are responsible for replacing it. So at the end of the day, less is more. Do the bare minimum, but good quality bare minimum, but never please go overboard because, believe it or not, the rules in London are quite different to the rules in Singapore when it comes to rental. And you know, for an example, over here in Singapore, we've got the maintenance levy of, we said, $200, and I'm responsible as the tenant. Unfortunately, we're not allowed to have a maintenance fee charged to the tenants whereby they're liable for the first £100 or £200. So that's an excellent point, and it's something I would always ask a landlord to bear in mind. Thanks for bringing it up.
Putting artwork and nice fancy.
Yeah,
Yeah.
sometimes as good as you are, it can backfire on you sometimes.
And that's actually my problem because
Yeah.
my apartment, I'm intending to live in it first.
Yeah,
And because I'm going to live in it, then I'm not going to I'm not going to stinge on myself. Right?
Correct.
So I'm going to like put like antiques and whatever. The thing is when I do decide to rent it out, then I probably have to move them all out. Because if the tenant should want them replaced at a later stage, it's going to be a huge headache.
Absolutely. Yeah. Does anybody else have any? Yeah, absolutely. Okay, no worries. Thanks very much. I can wipe the sweat from my eyebrow.
Yeah, no, Richard, you mentioned that there's like 52,000 under supply, and where do all these tenants going to live in if there's a shortage?
Well, it might be under Putney Bridge, actually, in a cardboard box. But you know, the challenge is that there's a huge deficit. So either people have to move further out of London, where it's more affordable, less expensive. Houses of multiple occupancy, HMOs, people living together in and renting rooms has become, you know, much more popular. It is an efficient way of using a property as well, in terms of the number of people you've got in it, rather than one or two people living in a 3-bedroom property. You might have 4 or 5 people, so it's more efficient way. So, you know, unfortunately, there are some homeless people in the UK, but yeah, I mean, the alternative is if you can't afford or you can't find something to your budget closer to the city centre, you're going to be forced to go further out or look at sharing.
If this is the thing, then okay. Another question would be that currently are the locals, the Londoners, are they being priced out of the London market? That's why properties are being sold worldwide.
So are you talking about the sales market now or the rental market?
No, the rental market.
The rental market, the sales market. Okay. So prime central London, so again, just that definition is, that loose definition, I say, is zones 1 and 2. Zones 1 and 2 is heavily driven by high net worth overseas investors who want a piece of one of the most dynamic cities in the world. That does mean that for a lot of people living in the UK, those prices are unaffordable. So if they wish to live in London, living in prime central London may not be an option. If they want to buy their property, they might need to be looking at zones 3, 4, 5, 6, where the price of the property on a price per square foot basis can come down significantly. So we call that a ripple effect. And typically, as a city centre prices become unaffordable, then people are literally pushed further out. But this is why having connectivity and infrastructure and transportation improvements makes such a difference, because with the likes of Crossrail coming into operation, you could be living in zone 5 or 6 and now getting into the city centre in 25, 30 minutes, whereas previously, depending on the connections, that could have taken you 45 minutes or so. So with the improved connectivity, it starts to open up pockets around the outer skirts, which is less expensive, more affordable, but still has the connectivity if they need to travel into the city centre for work.
Given the cost of time travelling and the cost of the train costs and all this.
It might be that the company pays for transportation. Some companies do, but it's very common. Absolutely. My sister-in-law used to travel about an hour and a half each way. My brother-in-law in Tokyo, it's even worse. He used to travel 2.5 hours across Tokyo to Yokohama and back every day. 5 hours commute every day. So it's a bit of a mindset in terms of what people are expecting. Singapore, anything over half an hour, I'm going to quit my job.
You can easily travel 45 minutes in London. I used to live quite close to Mill Hill, and our head office is in West London, and typically you travel 45, 50 minutes one way to get to work on any different.
Basically, London is a rental market rather than a resale market. I mean, when you buy, it's more or less keeping a longer term, more for rentals rather than from now onward.
Yeah. We always say that when you purchase your investment in London, you need to give it a 5-year outlook to achieve its true capital appreciation. So you are looking at a minimum of 5 years as to for the length of time you're going to be renting. So is that.
You're talking about if overseas buyers buying into London property. So the next person who's going to take over will
or a local investor as well. We're seeing a good upsurge in local UK investors in the London market at the moment as well. That's as per conversations I've had today. So UK investors are back in the market as well. Plus, well-established developments in London in good locations and well looked after will also attract your first-time buyers as well. So there's a good market for resales in London as well, on the resale market.
So generally, when you look at the Singapore properties and also the London properties and the salaries of the Londoners and versus our salaries, we're just wondering why the Londoners are not really purchasing the properties there. And I do not know what is the percentage that is the Londoners versus the overseas investor, because I see a lot of pitching to outside UK.
I don't have the data to say what percentage of people, let's say in prime central London, that are bought by overseas investors and locals, or for that matter, Greater London as well. What I do know is, I mentioned, there is a 14-year high in terms of the ratio of the lack of supply but the high demand. And what we can track is the number of days a property stays on the market. And at the moment, I was reading the average time to resell a property in London at the moment is about 36 days. That used to be, I think, closer to about 60 plus days. So because of this supply-demand imbalance and the fact that people are looking to take advantage of low interest rates, larger spaces, a lot of people upgrading, the supply-demand imbalance means that when a property is on the market, if it's marketed at fair market price, it's flying off the shelves at the moment.
One last question. For off-plan prices, how often, or is it a norm that once come to completion, the value of the property has
A down valuation. I think I'll pass over to Scott. Is that okay?
Sure.
For down valuation,
Yeah.
how often is down valuations occurring?
This is going to sound really cheesy, but with Barrett properties, it's never really an issue. That's my experience, and certainly in recent years. So with your larger reputable developers, their research and their back catalogue, they know what they're building, they know what they've paid for the land, they know who their target market is. So they tend to price things right. They're fair, in fairness. Obviously there's profit in it for everybody, but Barrett properties, especially in London, tend to do okay. Beyond that, I wouldn't know the statistics off the top of my head, but I'm just now going through all my cases over the last 12 months in my mind, and definitely less than 5%, probably closer to maybe 2%. It's come back at a valuation slightly lower than expected, but not always the capital. Often the capital valuation is exactly right. It would just be the rental estimate was a little bit hot, and maybe that's come off a little bit. But it doesn't change, from a lender's perspective, it doesn't often change the amount you can borrow. It's just a slight adjustment to the figures. So no, I think 99% of the time you're going to be okay.
I just want a follow-up question. How, depending on the price, of course, let's say a buyer's product on this Western Circus, just use it as an example. 2 years after its completion, 2 years after renting off, and cold. How easy, how fast is it that we can sell at a certain price? Let's assume it's a 5% increase, 10% increase on the price that I bought for Western Circus, and after 2 years of rental, 5, 10% increase, for example. How easy is it to sell?
You're asking me to look into the future a small bit, but typically, I always compare it to like-for-like rental and sales. Yeah. And it's like a rent. If a property is overpriced in the rental market, it will sit and it won't rent, so it's costing you money. If a property is positioned correctly in the sales market at the price point where it should be, so for argument's sake, a 2-bed we price it 2 years after completion at 600,000. I'm only using that as an example. But more often than not, sellers will come to us and say, well, my expectations are 650. But the data, unfortunately, is not there to support a selling figure of 650. If we oblige the buyer or the seller and go to the market at 650, you're already putting yourself on the back foot because you've priced yourself out of the market. If you've priced yourself out of the market, you're not getting the inquiries, you're not getting the viewings, you're not getting the offers. So your property over a period of 4 to 8 weeks starts already to become stale. And the first 7 days of putting your property on the sales market is when it's at its peak in terms of inquiries. After that, it peaks and starts to taper off. Yes, you can do price adjustments. It'll peak. And if it's not, that price adjustment is not within the price range, it'll peak for another couple of days and tend to drop off again. Genuinely, if you price correctly in the market, you should have a sale done and completed within approximately, I would say, 3 months.
So what do you mean by price correctly? Let's say I buy these from Western Surplus.
Mm-hmm.
Sorry, maybe this is not a good example.
Okay.
Let's take something like historical.
Okay.
Because we're not trying to forecast.
Okay.
So let's say take something for historical and say that
Yeah.
I bought something for 500,000.
Yeah.
Keep it for 2 years.
Yeah.
Right? Rental is good.
Yeah.
Rental is like what, 4.5%, 4%.
Yeah.
Like if I want to sell it, do I sell at the price I bought from the developer, or how's that going to work, and how long is it going to take to sell?
Okay, well, it really depends on a number of factors, as in economies, any conflicts that are going on in the world, the UK economy, inflation, demand from buyers. As I wouldn't personally recommend, if you purchase at a good price and from a good price from the developer, and you already have experienced capital growth at the time of TOP, then after 2 years, in my opinion, you should have a healthy capital growth in the property. But if you're buying at market price from the developer and you're giving yourself 2 years, then I believe that may be too short. But again, it genuinely depends on a number of factors in the sales market. And genuinely, it's hard to predict. But I would say a 5-year outlook, but it depends on your purchase price as well.
Yeah, I understand.
So I'm not answering the question, but there are a lot of factors involved. Yeah, yeah,
I'm just taking to all the presentation that you
yeah.
guys are making, which is quite good. And based on Richard's presentation on how the price is going, like,
Yeah.
Quite consistently, but it's going up. So we just have to assume that one first assumption is that we're buying at the right price from the
Correct. Yeah.
which was the gentleman said, we buy this price.
Mm-hmm.
Let's see how it's going to work out. And based on Richard's forecast, that it should be going up.
Absolutely, it should. Yeah,
Depending on the area and all that.
yeah.
So
But 2020, at the beginning of 2020, we were very bullish and very optimistic about rental and sales market. And within the space of 3 months, the whole thing flipped 180. So and that's why I'm not being evasive. It's just, yeah,
I mean, that's an outlier, right? Because outlier, you just take out outlier.
yeah,
But in general terms, if you don't do it in that, let's take out the 2 years of COVID, right?
yeah, yeah.
Right, let's look at a 5-year period, like last historical, I know there's a problem with COVID as well as the Brexit, but still, as an investor, we need to, we have to look at, we don't look at 2 years, we look at 3 years, look at 5 years, right? It's okay because the rental is good. Like you said, the rental is very good, right?
Yeah, the rental yields, as I said, minimum will be 4% in both of those developments.
The rental is very good.
Yeah,
The thing is, at the end of the day, unless you go and live there, actually, else you're going to sell it.
yeah. Like we will always give rental projections that are genuine. We're not going to overcook rental figures with the hope that we're going to take the stock on board, and then all of a sudden, well, our rental projections are wrong, the market has changed, and now we're not going to give you what we promised. So we're always exact, even maybe a little bit conservative, because we don't want to over-promise and maybe under-deliver. And especially with new builds coming to the market, it will create short-term supply in that pocket for maybe 1 or 2 months. So we're always a little bit conservative as well. But the way the market is going and what we're seeing in the market in London right now, based on feedback that I'm getting today from the sales managers in London, there is very good demand starting to happen again from UK investors who want to get back in. So based on Richard's presentation and based on what you're saying about a 2-year after 2 years after completing, you would definitely expect there to be capital appreciation and to sell at a profit.
Is that local? Is that local help to buy is going to end soon, or is it uncertain?
I have heard nothing in the press or from home when I'm getting feedback or keeping in touch with the guys who said that it's coming to an end.
Is that a cap on 600,000?
For London, I think it's 600,000.
For London, 600,000.
And I think it's something like, I think it's 300,000 outside of London in certain regions.
So 600, you're talking about a two-bed.
Yeah.
Two-bed
Well,
prices. Depending on the part, yeah, depending on the location, yeah, obviously.
I'm conscious of time, ladies and gentlemen. We're getting close to 9 o'clock, and I'm hoping that you're still there if you're available online. Maybe if I can just say, look, let's just have the last few questions, and if anyone would like to stay behind, we might be able to have a drink as well, and speak to us personally. Would be delighted to do so. So let me just ask if there's any last real burning questions for the three amigos. Yes, James.
How do I know, how transparent is the market? How do I know transaction prices around that development so that I could judge for myself whether the selling price is transparent?
Is a fair price. So, I mean, there are many, thank you, there are many portals, rightmove.com as an example, the biggest property portal, it's like the Property Guru, there's Zoopla and other ones. It's so easy these days to go online to see what transacted prices are and get data, so you know that you are either buying that property at fair market value or below or above. And when you come to setting your price, if you're selling, again, you can be realistic in what the market transactions are doing. So it's very easy these days.
It's for sales and rental.
Yes.
Thank you.
And we can run reports in the background on Rightmove if you wanted more in-depth data. That's possible to do as well. So we would have more data in the background, than you would have as a member of the public. It's called Rightmove Plus that we have access to, and it's more in depth.
Thank you.
No worries.
There was one question online, which I'll quickly address,
Okay.
if that was all right. It was just about the equity, refinancing to release the equity.
Okay.
So just to run some very simple numbers again, and hopefully this gives the concept. If you buy a property for 500,000 today, for example, and then in 2 years' time, and you borrow 75%, in 2 years' time, if that property is now worth 700,000, you could potentially refinance, assuming all the other numbers work, you could refinance for 75% of the new value, and any cash that provides over and above the original mortgage loan is then released to you, and then you use that cash to invest in additional property. But if you want some working examples of that, I can send them to you, or email me, and I can get it across to you to have a look at. So I hope that makes sense. And last point on the valuations, etc. There is that, and if you want to pay for an independent valuer to go and have a look, they're also available for you to do that, and they'll use market research, they'll use the same stuff as Column, and then they'll put it into a full report for you as well, with no edge, if that makes sense. Yeah.
Okay, Pearl, last question of the night then. Yeah.
If I have planned to move to London, and then is it best that I go there first, and then I buy a house so that I can enjoy the resident mortgage rate, which is much better than the non-resident mortgage rate, right? The interest rate.
If you're going to buy a property for residential use, regardless of where you are in the world, you'll get it at UK rates. There's no difference.
I don't have to move there to get a residential mortgage rate.
No,
Oh.
not necessarily.
So I just need to claim that for my
No, you don't have to claim, you have to be true.
Maybe, when I get there, I find I actually like somewhere else a bit better, and then I would like to rent this one out. Then how so it goes back to a bit like this question.
Again, if that was genuine, then the lender will take that into account and make a decision.
But I need to let them know.
Of course, that's the law. It's in your contract. Your mortgage is a contract, and there's terms and conditions within the contract. If the lender were to find out that you had broke those terms and conditions, they're well within their rights to ask for all the money back immediately.
It's called consent. It's called consent to let.
Yeah.
So it's just like the same like your home insurance. If you list as an owner-occupier and you're going from owner-occupier to letting, you need to inform your insurance company that you're now going from owner-occupier to renting.
But then if I start with like a letting out and then I want to live by myself, I can also inform and then enjoy a lower interest rate.
Potentially, yes. No problem. Banks will make money from you regardless.
Because I'm from China and there is no difference.
Right.
What you buy,
Well, but it's in China.
yeah?
It's not in London. Yeah.
I need to learn about London.
Good. All right. Lovely.
Thank you very much.
Thank you, everybody.
Thank you all, and
It was
thank
very
you for those of
enjoyable.
you online. Again, if you'd like to stick around, it's Friday evening, so relax, chill, have a few drinks, and have a chat with the staff and some of the other people that you've met tonight. So, thank you.
Thank you.
Thanks
Thanks
a lot.
very much. Thank you.